In the shadows of our financial system, a select group of organizations hold immense power over our economy. They are the credit rating agencies, or CRAs, and their role in the 2008 financial crash is a story that needs to be told. Imagine for a moment you're buying a new house. You go to the bank, apply for a mortgage, and they approve you for a loan of $300,000. But how did the bank know you could afford it? How did they trust that you would pay them back? The answer lies with CRAs like Moody's, Standard & Poor's, and Fitch Ratings. These agencies provide credit ratings for borrowers, from individuals to countries. A high rating means you're a safe bet, while a low rating suggests you're risky. This rating system is crucial because it influences interest rates. The higher the risk, the higher the interest rate. In 2006, CRAs gave their highest ratings, AAA, to mortgage-backed securities worth over $2 trillion. These MBS were made up of thousands of home loans, bundled together and sold as investments. But here's where things get interesting and troubling. Despite warnings from their own analysts about the riskiness of these products, CRAs continued to give them top ratings. Why? That's a question we'll explore in this documentary. What we do know is that by the end of 2008, over $5 trillion in MBS had been downgraded, causing massive losses for investors worldwide. The fallout led to the Great Recession, which cost the global economy an estimated $10 trillion and resulted in millions of job losses. So, who are these CRAs? How did they become so powerful? And how did their actions contribute to the worst financial crisis since the Great Depression? These are questions that demand answers, and we're here to uncover them. Welcome to The Money Trail. Let's dive into the world of credit rating agencies and investigate how their decisions helped cause the 2008 financial crash. The Money Trail continues to unravel the complex web of events that led to the 2008 financial crisis. Now, we turn our attention to the role played by credit rating agencies, or CRAs, and their infamous AAA ratings. Investment-grade bonds, those considered safe bets for investors, are typically rated AAA, AA, AA, and BBB by credit rating agencies like Moody's, Standard & Poor's, and Fitch Ratings. These agencies evaluate the financial health of issuing entities, be it countries or corporations, and assign ratings based on their ability to meet debt obligations. However, in the early 2000s, CRAs started giving top-tier AAA ratings to mortgage-backed securities tied to subprime mortgages, those given to borrowers with poor credit histories or high debt levels. Between 2000 and 2007, S&P rated over $2.5 trillion of these risky MBS as AAA. Fitch followed suit, awarding AAA ratings to more than $1.6 trillion during the same period. Why does this matter? Because a AAA rating implies an extremely low default risk, less than 0.1% according to S&P's own definitions. This encouraged investors worldwide to buy these securities, believing them as safe as U.S. Treasury bonds. As a result, financial institutions invested heavily in these instruments, often using massive amounts of borrowed money, creating what we now know as the infamous toxic assets. When the housing bubble burst in 2007, many subprime borrowers defaulted on their payments, causing huge losses for those holding these securities. Yet, these losses could have been mitigated had the CRAs accurately assessed the risk associated with these investments. Instead, they perpetuated a culture of complacency and recklessness that ultimately fueled the crisis. The question remains, how did CRAs get it so wrong? In our next segment, we'll delve into the conflict of interest at the heart of this fiasco, one which reveals a disturbing truth about the power dynamics within the financial industry. Stay tuned to The Money Trail as we continue to unravel the complex web of events that